Welcome to The Explainer. Today, we're taking a fascinating 5,000-year journey into one of the absolute most fundamental forces in human history, money. We're going to explore exactly how human trade evolved, going all the way from swapping natural objects in ancient times right up to the invisible digital codes that power today's global economy. It's a massive story. It's about innovation, necessity, and really, most importantly, it's about human trust.
So think about this for a second. What could 1200 BCE cowrie shells from the Pacific Ocean, giant carved limestone discs from Yap Island, and modern cryptocurrency possibly have in common? I mean, on the surface, absolutely nothing, right? But as we'll see throughout this explainer, they all share this one kind of invisible, almost magical property. They possess value simply through social convention and trust. Money doesn't always have intrinsic value. Its worth depends entirely, literally 100% on the importance that we, as a society, place on it. But what actually makes money, well, money? Economists basically agree that to do its job, money has to hit three core functions perfectly. First up, it's got to be a universally accepted medium of exchange. That just means you can easily trade it for goods and services. Second, it acts as a unit of account. It gives us a standard numerical measure so we can actually price things and keep track of debts without going crazy. And third, it absolutely must be a reliable store of value, meaning you can save it today and it's going to predictably hold its purchasing power when you go to spend it tomorrow.
To really get why money was invented in the first place, we have to look at the sheer inefficiency of what came before it, which is the barter system. Bartering is just a direct trade of goods and services, sure, but it requires what economists call a coincidence of wants. Picture this. You're a farmer trying to trade a bushel of wheat for a pair of shoes. Well, the shoemaker has to actually want your wheat. Or, say you're trading a stone axe in exchange for someone, going out and killing a woolly mammoth for you. You have to find someone who actually thinks that specific tool is a fair trade for facing down 12-foot tusks. Honestly, it was just way too slow and way too rigid for growing societies.
So the solution definitely didn't happen overnight. The earliest standardized currencies were actually just items from nature, things that were small, durable, and roughly the same size. Think of cowrie shells, which were used way back around 1200 BCE. But the real breakthrough? That was standardizing metal. Fast forward to around 640 BCE, over at a site called Guangzhou in Henan Province, China. Archaeologists there found the world's oldest known coin minting facility. This is where they started striking these standardized spade coins. And then, shortly after that, another massive leap happened further west.
Right around 600 BCE, Lydia's king Alyattes minted what we believe to be the very first official regulated currency. These were kind of these bean-shaped coins, and they were made from electrum, which is a natural mix of gold and silver. And they were stamped with this royal lion symbol to show their exact denomination. This brilliant little invention actually helped Lydia become an incredibly wealthy empire. It made Alyattes' son, Croesus, absolutely legendary for his riches, and it massively boosted both their internal and external trade, a real game-changer.
Metal wasn't the only solution people tried out, though. Early on, places like ancient Rome, Russia, and Carthage actually experimented with leather and animal hide as currency. But hands down, the most fascinating example comes from Chinese Emperor Wudi in the 2nd century BCE. Get this, he created this elaborate fringed currency, made out of skins from his own personal collection of white stags. Now, obviously we don't use that today, but some historians actually believe this unique stag leather money is the origin of the modern slang term buck when we talk about a dollar. Pretty cool, right? Now, as international trade kept expanding, a brand new problem popped up. Those heavy copper coins, they became incredibly burdensome for merchants to lug around. The Chinese Song dynasty, somewhere between 997 and 1022 CE, completely solved this by inventing paper money. Since paper originated in China anyway, it was a pretty natural leap. They actually made this early paper currency from the bark of mulberry trees. So in a very literal sense, early money actually did grow on trees. This innovation was huge. It allowed for faster, lighter, and just way more extensive commerce across the board. But as you can probably guess, with this new paper technology came a familiar danger: counterfeiting. Because paper money had absolutely no intrinsic value like gold did, it was incredibly tempting to just fake it. And authorities took this threat very seriously. As Marco Polo observed when he visited China during the Yuan dynasty, their paper currency actually carried a stark, terrifying warning. Counterfeiters would be decapitated. And this wasn't just an Asian thing either. Over in England, perpetrators caught forging currency were known to be burned at the stake. Securing money has literally always been an arms race. In the American colonies, where counterfeiting also carried the death penalty, Ben Franklin actually used his printing firm to devise this really clever trick. He intentionally misspelled the word Pennsylvania on the bills. Why? Well, he knew that forgers would look at it, assume it was a printing error, and correct it on their fake notes, which of course instantly gave them away. Today, the stakes are a bit different. The maximum U.S. prison sentence is 20 years, and a modern $20 bill relies on high-tech watermarks, security threads, and raised printing to outsmart today's counterfeiters. As paper money spread around the globe, it evolved from being just temporary receipts to full-blown government-backed systems. Back in the day, shipments of coins from Europe took so long that colonial governments constantly faced cash shortages. In fact, in 1685, the French colony of Canada got so desperate they issued signed playing cards as IOUs just to pay their soldiers. Eventually, to stop governments from just printing paper money endlessly, the United Kingdom introduced the gold standard in 1821. This tied paper currency directly to a fixed quantity of actual gold. And that system reigned for a long time, right up until the 1970s when the U.S. fully decoupled the dollar from gold, which created the unbacked fiat system that we all use today.
And that right there illustrates the absolute main danger of fiat currency. Without a physical commodity, like gold, to restrict the printing presses, governments can pretty much issue money at will. And if they print too much, well, the currency completely loses its store of value function, and that leads to hyperinflation. A prime example of this is Zimbabwe in the early 2000s. Their currency inflated so rapidly that the government literally had to issue a single banknote with a face value of $100 trillion. $100 trillion! And the crazy part? That $100 trillion bill was barely enough to buy a single loaf of bread. Now, trying to escape the limitations of physical paper, the mid-20th century kicked off this massive transition from physical cash over to electronic databases. In 1950, the Diners Club Universal Credit Card was introduced. Then, American Express debuted the very first plastic card in 1959. Fast forward to the 1960s, and IBM completely revolutionized the system by inventing the magnetic stripe. This little stripe held your account data and totally eliminated the need for merchants to phone in for authorization. But as you might expect, all this frictionless spending led to some massive behavioral shifts. By 2017, American consumers were carrying $1 trillion in credit card debt. Entering the 21st century, money became almost completely dematerialized. We officially entered the mobile revolution. Starting with just simple SMS text payments, the tech rapidly evolved. Soon, people were depositing checks just by snapping a photo with their smartphone cameras. And today, platforms like Apple Pay, Venmo, and PayPal allow for instant global transfers and point-of-sale purchases, all without ever needing to step foot inside a physical bank branch. Think about that. Money has literally just become data.
Which brings us to our final technological leap. In 2009, an anonymous programmer, or maybe a group of programmers we still don't know, going by the name Satoshi Nakamoto, launched Bitcoin. Now, this fundamentally changed the definition of currency, because it's a completely virtual, entirely decentralized system. It's not issued by a central bank, it isn't regulated by any government. Instead, this borderless, distributed network of computers enforces the rules and keeps track of all the transactions completely anonymously.
So how is this digital money actually created? Well, it happens through a process called mining. But obviously we're not talking about physical digging with a pickaxe here. It's entirely computational. Computers all across the network race against each other to solve these incredibly complex math problems. We're talking about nearly 7 trillion attempts before a solution is found. Once a computer finally solves it, it verifies a block of transactions, which secures the network, and the owner of that winning computer gets rewarded with brand new bitcoins. But here is where Bitcoin elegantly circles all the way back to ancient history. Remember how gold and those cowrie shells worked so well because they were naturally scarce? Well, Bitcoin mimics that exact scarcity property, but it does it through pure mathematics. The system actually has a hard-coded cap. There will never, ever be more than 21 million Bitcoins created in total. By enforcing this strict limit, it's attempting to function as a reliable store of value, one that's totally safe from the endless money printing that causes hyperinflation.
Looking back over 5,000 years, it's pretty incredible. To meet the ever-changing needs of commerce and technology, we've gone from lugging around heavy limestone discs to trading stamped electrum, from exchanging mulberry tree bark to swiping magnetic stripes, and finally to beaming decentralized code around the world. The form constantly changes, right? But the foundation never does. It's all built on human trust. As long as we trust a medium to hold and transfer value, it's money.
So as we look down at our phones and our digital wallets today, it leaves us with one really powerful question. What will we trust as money tomorrow?